Hi, welcome back to my ESG channel. Now we are getting close to the end of the course. Today we are going to talk about Chapter 8 on Integrated Portfolio Construction and Management, which is the second last chapter of this course. But again, before we begin, could you please have a look at the key issues that we counted last time and see how many of them you can remember. Here is Chapter 8, and here are the learning outcomes. Before we'll talk about each learning outcome. I want to say that for a number of topics, I've reshuffled the content under learning outcomes that are different from what you can see in the notes, because I think after this reshuffling, the flow may be clearer than what's actually presented in the notes. So the first one, explain the impact of ESG factors on SAA, strategic asset allocation. So pretty much, there are the approaches, strategic asset allocation and dynamic or tactical asset allocation. Because SAA itself is kind of more long-term, a through cycle time frame. So because for ESG integration is also consistent with a long-term approach, and therefore SA is considered more appropriate for ESG integration rather than so-called dynamic or tactical asset allocation, because they involve continual rebalancing over short time periods. Therefore, this kind of process may diminish the value of ESG integration. And the last point is in the kind of traditional investment approach, things like governance is always considered, but then if we talk about ESG research, naturally we actually put more emphasis on so-called environmental criteria, and for social and governance, as I've just said, they are considered. But then, if you talk about ESG research, then those considerations are considered kind of more given. So, so-called ESG research, I've just said, tends to focus on environmental criteria. And then, there are a number of ESG integration issues on SAA. And the first one being that a lot of these were SA models. So the most familiar one will be the so-called mean variance optimization, based on so-called modern portfolio theory. And for some of you, you may be very familiar with things like, say, efficient frontier. So it is this kind of approach. But then this kind of approach is very sensitive to assumptions. And then because ESG issues are difficult to quantify with precision, so minor changes to estimates can lead to dramatic output changes. So models that do not require return estimates, like the so-called Black-Litterman asset allocation model, BLM, could be more promising in implementing ESG integration. And then, because ESG approach has traditionally been equity-focused, its relevance has tended to be muted or at best underrepresented within multi and mixed asset allocation. Although, as we will see later in this chapter, ESG integration is indeed implemented for non-stock asset classes. And ESG integration will undoubtedly carry exposure and weighting implications, for example, say positive screening or exclusions, hence introduce some diversification effect, or actually lack of diversification, like say concentration risk or skewness. And we also need to consider trade-offs between near and long term. Although ESG integration is meant to be long term, but then inevitably there will be short-term impacts. And climate change represents different risks across asset classes. For example, say the impact may be different between, say, equity or fixed income. And then, when implementing SAA as recommended by TCFD, one should consider so-called climate scenario analysis. That is, well, the 1.5 degrees Celsius or 2.7 degree Fahrenheit scenario in the Paris Agreement as a baseline. And then for this, well, climate scenario analysis, there are initiatives to help investors doing this kind of scenario analysis, and the initiatives include Paris Aligned Investment Initiative, Transition Pathway Initiative, Net Zero Asset Owners Alliance, Net Zero Asset Manager Initiative, and also the Net Zero Company Benchmark. And in ESG integration, both physical and transition risks should be considered. Well, we talked about physical and transition risks in the previous chapter, so if you have difficulty remember what they are, then I think you need to go to the older chapters. And transition risks include the so-called inevitable policy response (IIR), that is, governments may potentially respond to increasing climate-borne damage in a sudden reflex reaction. Right, this slide is about the measure selection process. And allocations are increasingly integrating ESG factors and expectation into their measure selection processes. And easier to be considered will include for the measures like whether the measure has got an ESG policy, and whether the measure is affiliated with investor initiatives such as PLI, and accountability in the form of dedicated personnel and committee oversight, and the manner and degree in which ESG is integrated in the investment process, including compliance measures to ensure that exclusion-oriented and or ESG constraint-based investment mandates and strategies are observed. And the last being ownership and stewardship activities and client reporting capabilities. Right, then now comes number 2. Describe approaches for integrating ESG into portfolio management process. And ESG integration requires embedding ESG considerations into the following: for the highest level asset allocation decisions, portfolio exposure non-financial factors. Well, certainly, well, financial factors are considered, but then in ESG integration, we also need to consider portfolio exposure non-financial factors, risk management measures, and performance attribution. Well, performance attribution are a bit problematic, and we'll talk about that a bit later. Right. Well, this slide, well, the content of this slide actually appears in notes under outcome 8.1.6, but then I have moved this part to under the outcome number 2, as I think the flow is better when I do it this way. So ESG integration may be considered for risk mitigation and alpha generation. And then for risk mitigation, there are different types of risks that we should take note. The first one being the so-called tail risks. Tail risks are long-term in nature and with potential for significant change or move of risk profile by several standard deviations. So, well, to put it in a different way, so these risks, they are long-term. The probability of such risks occurring may be low, but then, well, the impact when such risk actually occurs can be quite high. So example includes a property, beachfront property at risk of coastal retreat, and for European utilities, carbon price volatility, and stranded asset risk. Stranded asset risk means, well, the premature and unanticipated write-down risks. And idiosyncratic risk, well, that you may be familiar with. That is firm or stock specific risk which may be reduced or mitigated via diversification. And then, well, the opposite of idiosyncratic risk will be the so-called systematic risk. And systematic risk cannot be resolved just via diversification, so they'll include market risk like, say, economic recession. And risk may be represented by both quantitative metrics like a weighted average carbon intensity or WACI, and subjective ESG scores and ranking. And I hope you still remember what WACI is. And then apart from risk mitigation, ESG integration may also be considered for alpha generation, although that's kind of more problematic because measuring ESG attributive performance is quite challenging. There are two different ESG investment strategies, which are discretionary and quantitative. Discretionary is pretty much to complement bottom-up financial analysis alongside the consideration of ESG factors to reinforce the investment thesis of a particular holding. So it's process-oriented and a so-called fundamental portfolio approach. The opposite will be rules-based, so that employs statistical application of financial and non-financial factors to minimize the higher costs associated with discretionary active management. So quantitative will involve things like the ESG scores. Although discretionary in a discretionary approach, one may also figure out ESG scores, but then it's not that we base certain investment decisions just based on certain scores or certain quantitative factors. Right, this part, this is a regulatory part. In notes, this part appears under learning outcome number 6, but then, honestly, it's kind of hard to figure out why this regulatory part appears under this chapter, although, indeed, it appears in this chapter, and I think it's probably better to be under outcome number 2, because I think it's better to put it this way, because this part is talking about the approaches for integrating ESG. So regulatory impact will be a factor to consider when one does ESG integration. So in that case, about SFDR, for SFDR, Sustainable Finance Disclosure Regulation, we actually touched upon this a bit under chapter 3. So I hope you still can remember this. SFDR focuses on disclosure at the entity or measure and the product or investment strategy levels. It applies to financial market participants, i.e., fund and asset managers, insurers, pension funds, banks, and investment firms. That requires disclosures on sustainability risks and factors and on certain environmental and social aspects of the financial products on a pre-contractual. That's pretty much upon the sales process and on periodic basis and on websites. SFDR categorizes investment products into 3 major groups, which we actually mentioned briefly under chapter 3. These are the so-called Article 9A and 6 products. Article 9 are so-called dark green funds, which have sustainable investment as their objectives, environmental or social, but must do no significant harm or DNSH to either of these objectives. That is, a certain fund may be quite strong in a certain investment objective, but then, there should not be a significant side effect which may harm other objectives. Article 8, so-called light green. These are products that more broadly promote environmental and non-social characteristics, but less green than Article 9 products. And then the others under Article 6. And the actual format or the actual content is defined under so-called RTS, Regulatory Technical Standards, and it supplements SFDR by providing detailed guidance on disclosures relating to principal adverse impacts or PAIs on sustainability factors, and among others, It defines a mandatory reporting template which states the following. Mandatory indicators of invested companies to be disclosed such as greenhouse gas emissions, well, scope 1, 2, and 3, carbon footprint, greenhouse gas intensity, exposure to companies active in the fossil fuel sector, share of non-renewable energy consumption and production, etc. And information such as policies on the identification of PAIs and actions and plans to mitigate PAIs. And the frequency is annual, and the party should report by the 30th of June, so the first actually happened on 30th of June 2023. And that's a comply explain approach. So I see it can be quite challenging. For example, say disclosing includes greenhouse gas emissions, and then we note in the earlier chapter that Scope 3 emission is the most difficult to quantify. Right. Well, apart from the EU regulation, apart the EU SFDR, CFA has also come up with so-called global ESG disclosure standards for investment products. This CFA initiative is not anchored by any one regionally specific regulation or prescriptive standard, so in a way, this can be considered one of the global standards for ESG disclosure. And these standards states disclosure requirements on the following things, such as systematic consideration of financially material ESG information, use of an ESG index, use of ESG screening criteria, use of ESG targets and constraints, benchmarking of ESG characteristics or performance, incorporation of ESG information or ESG issues into stewardship activities, and incorporation of specific environmental and social impact objectives alongside risk and return objectives. So number 3, explain approaches for how internal and external ESG research analysis is usable by PMs to make investment decisions. Describing ESG performance attribution requires quantifying ESG as a factor of risk premium in its own right. And the most popular approach is the development of an applicable ESG rating and scoring that may come from internal research, external vendors. And because there is subjectivity in divergence among ESG rating providers, we have actually touched upon this in the last chapter. An approach that incorporates both third-party and proprietary ESG data lowers an over-reliance on a single provider. And then in any case, in last chapter we actually learned about the shortcomings of ESG data. So, although these ratings and methodology are sophisticated, many still fall short in describing ESG as an uncorrelated, statistically independent factor. And in fact, the ratings reveal a significant underlying correlation to existing factors, and this effectively undermines the effort to define ESG as uniquely singular enough to be included in risk factor attribution analysis. And now learning outcome 4 and 5. Explain the different approaches to screening and the benefits and limitations of the main approaches, and then explain the main indices and benchmark approaches are applicable to sustainable and ESG investing, noting potential limitations. Screening is the oldest and simplest approach, and then exclusion-based approaches remain the largest portion of dedicated ESG screen AUM according to the statistics of Global Sustainable Investment Alliance. This is not too surprising because, as mentioned, it's the simplest approach, so there's no surprise that, so far this is the most widely adopted approach. And screening, there are 4 main approaches. First, universal exclusions. They are supported by global norms and conventions, like those of the United Nations and World Health Organization, such as controversial arms and munitions, cluster munitions, anti-personnel mines, and nuclear weapons, tobacco, and varying degrees of exposure to coal-based power generation or extraction. The second being conduct-based exclusions, which are generally commonly or country-specific, and often not a statement against the nature of the business. For example, say, excluding companies that violate International Labour Organization principles. Faith-based exclusions specifically relate institutional or individual investors, say maybe Christians or Muslims. Idiosyncratic, these are exclusions that are not supported by global consensus. For example, New Zealand pension fund exclude companies involved in processing of whale meat products. Issues and screening. Exclusions are more commonly adopted as owners rather than asset managers. So it's pretty much say in mandates, the asset owners will set exclusions and then asset managers will follow, but not so much the asset managers themselves will say that they will not invest in certain things. And with exclusions, there is a small investable universe, and hence high tracking error and active share, and intended sector exposure. Because if you can't invest in certain things, they may need to invest more in certain other things. So therefore, they may lead to bigger sector exposure in sectors that are not excluded. And a conventional benchmark, that's the normal benchmark, which i.e. not the ESG benchmark, may be used if the exclusion list is short or narrow enough. But then if the exclusions are broader, like say excluding an entire sector, then one may need to consider an ESG benchmark. And there are so-called synthetic assets, like say derivatives, that fall outside the conventional ESG framework. Hence in practice they may be omitted from the exclusion list. And finally, screening may be considered so-called reductive. That is, there's no consideration of softer forms of ESG like stewardship and engagement activities. Okay, we talk about how to apply ESG in different asset classes. So this is equities. Actually, I'll say that a lot of development in ESG integration revolves around the application of such to listed equities. So therefore, for listed equities, that's a mostly developed asset class in terms of ESG integration, due to high transparency and the ability for investors or shareholders to exercise their view through their voting rights. And apart from the conventional long-only approach, hedge funds or long-short strategies are increasingly embedding ESG into portfolio construction and management. Fixed income. One characteristic peculiar to fixed income is that different securities of same issue will often have multiple risk profiles, like different maturity dates. So for example, a credit portfolio manager may manage long-term climate risk by only investing in issues shorter dated maturing debt. And there are so-called ESG investing bonds that have emerged, designed to raise funding to deliver social and environmental objectives alongside a financial return. We touch upon this topic in chapter 3, and in the next slide I'll talk about the different types of ESG bonds. Although so far there's no universally recognized standard certification system for sustainable bonds, although there are a number of standards that have emerged. For example, the EU Green Bond Standard, but then it is voluntary and requires at least 85% of bond proceeds to be allocated to economic activities that align with the EU taxonomy. And there are also so-called green securitization securities, like say so-called green CLOs. They're created by repackaging illiquid green assets. And outside the corporate bond universe, it can be more challenging to apply ESG screening for sovereign debt because they are further reduce the investable universe. But then, investors if you really want to do so, they can make use of information from credit rating agencies and the World Bank's Worldwide Governance Indicators database. And the database has got information on political stability, voice and accountability, government effectiveness, rule of law, regulatory quality, and control corruption for almost all countries in the world and over a fairly long period of time. So these are types of ESG investing bonds. Green bonds, they are those that provide clear benefit to the environment, such as renewable energy projects, also called climate bonds. And although this seems to be quite clear in practice, there are also green bonds that may have so-called fairly wide use of proceeds, and then sometimes it'll be hard to kind of fully appreciate that the use of proceeds are indeed that green. Social bonds. Social bonds are those that fund projects for essential services, infrastructure, and social programs to underserved people and communities, like affordable housing, microfinance, healthcare, and education. Sustainability bonds. They are more broadly defined bonds that still create a positive social and environmental impact. Sustainability-linked bonds provide financial issuers who commit to a specific improvement in sustainability-linked outcomes, but not necessarily for specific projects. And an example would be, say, an issuer may say that if we can meet certain reduction criteria, or actually more commonly, if an issuer fails to meet certain objective in 10 years time, then the interest on the bonds will increase. So these are so-called sustainability linked bonds. And then transition bonds, they provide financing to brown industries to transition to greener industries. There are also SDG linked bonds. They are bonds that are linked to the 17 goals of the United Nations. Blue bonds fund projects with clear marine and ocean-based benefits, such as sustainable fishing. So after fixed income, we have got private equity. But it's quite obvious that although one can do exclusionary screening, investors do not have the benefit of the breadth and diversity of indices and benchmarks of this equity space. And the general partners may apply some screening or thematic focus, and the limited partners are increasing their expectation for GPs to integrate ESG analysis beyond screening. And because PESG there may be more localized or regional, hence capabilities from these equities may be of limited use. Real estate. The so-called GRESB, Global Real Estate Sustainability Benchmark, provides methodology and framework to measure ESG performance, but data availability is limited to participating companies, funds, and assets. Investors may also leverage the modeling capabilities and experience data of general insurance companies to understand what their current risk. Because in setting the premiums of insurance products, the general insurance companies, they need to have a certain long period of experience data, and also the ability to model claim events. So the general insurance companies, they may be very suitable in providing the insight or data regarding the climate risk of property. And then the traditional residential housing model delivery has little regard for ESG factors with a significant carbon footprint. But then the ESG impact may be improved by reducing carbon footprint or deliver affordable housing solutions that provide greater social segmentation. And finally, Investors may also profile the exposure to elevation and coastline proximity to assess flooding risk. By screening, distinguish between ESG screening of individual companies and collective investment funds. PRI recognizes three main approaches to screening. Negative, avoid the worst performers. Positive, invest in the best performers among peers. Non-space screening, screen issuers against internationally recognized minimum standards of business practice. And there are 6 steps in screening. They appear more appropriate for screening funds and probably not so much on individual companies. The 6 steps include identify client priorities, publicize clear screening criteria, introduce oversight, adapt investment process, review portfolio implications, and monitor, report, and audit. And screening may be done on absolute or relative basis. Absolute means attributes low scores to certain industries or sectors, and may sacrifice diversification because it means that for companies or scale or sectors that have low scores, then automatically they will be excluded. And one can also do so-called relative or peer group basis, and because it doesn't mean that certain industries or sectors will be automatically excluded, then it will be better for building and maintaining a balanced, diversified portfolio, and prevents wholesale exclusion of poorly related companies and mining. So for this last one, it can be a benefit or can be a shortcoming depending on the purpose of the screening. And finally, doing screening, we may see that a fund with high sustainability rating, but then if not because the fund has ESG integration or good ESG process, but it may be kind of the result of coincidence, like the fund has low exposure to carbon intensive industries or high ESG rated companies by chance. Example, maybe a fund will be in tech companies or maybe in mostly finance companies, and these companies do have a lot of carbon emissions, so this fund may have a high sustainability rating even though the fund itself may actually have no ESG integration at all. Okay, number 8. ESG integration may be implemented via optimization, so organizing securities by the ESG profile and weigh against trade-offs. For example, less diversification. And ESG integration has the potential to improve the risk-return profile of a portfolio. And then optimizing for broader, more subjective ESG data may introduce high active risk or tracking error. Yes, kind of because if you do ESG integration, then either you exclude certain companies or only pick the kind of better companies based on ESG scores that may not be totally objective. And then if your benchmark is a conventional index, then the active risk or check error can be quite substantial. Right, number 9. There are few socially responsible investment strategies. And the first one is full ESG integration, and it is a systematic process of fully embedding financial and ESG analysis into investment decision making and portfolio management, and that includes financial and ESG analysis and active management activities. Active engagement activities, integrating into the valuation process of a company. And by doing so, there will be fewer constraints than, say, exclusionary screening. And via such approach, the portfolios may be more concentrated in high conviction holdings. However, unlike, say, exclusionary screening, the approach lacks the easily understandable optics like a high performance ESG score or low carbon exposure. That is because, well, even for, say, a mining company or, say, a coal mining company, in a way, the company may be considered better than maybe certain peers, so it may still be included. So optically, the firm may look kind of less pretty when viewed using a so-called ESG lens. Well, the second being exclusionary screening. Well, we actually talked about this many times. Say via an ethical or normative framework, like say exclusion stocks like say tobacco, pornography, gambling, weapons, alcohol, energy extraction, like thermal coal, oil sands, and conventional oil and gas. And as we have actually mentioned more than once, that can have significant portfolio impact. And positive alignment or best in class, we actually talked about this long time ago at the beginning of this course. These are identified companies with better ESG performance than peers. Use a given ESG rating methodology. But then again, it's challenged by the diversity of rating methodologies, a lack of rating conversions, as we've learned in the previous chapter. And by definition, there is less scope to allow research in lower scoring companies that have potential to improve ESG metrics. Well, because we only pick the better companies, so for companies that underperform, so no, we will just exclude and will not bother with spending time on seeing whether or say doing engagement with this company and hope that they can improve in their ESG metrics. Thematic investing that targets sustainability-linked aligned themes, and by definition, because the investable universe is limited, it sacrifices the benefits of diversification. And then this kind of investing may lead to a greater portfolio return volatility due to say exposure to changing regulatory incentives or subsidies. Yeah, for example, say a fund may invest in renewable energy, but then government stance on renewable energy can be a changing one. Say subsidies may fall or may be cancelled if the government thinks the sector is mature enough and can sustain itself. So by removing subsidies, the impact on the companies can be quite substantial. And there can be a scarcity premium that affect the capital flows into other sector. So maybe if there's a lot of money chasing a certain sector, then the sector may become quite overvalued. But then if the flows decline, then the valuation drop can be quite substantial. Poor cash flow profiles, like a lot of these companies may start companies, and it may take time for these companies to become self-sustained and kind of beyond the high capex stage. And for thematic investing, different themes can have different characteristics. For example, clean energy tends to be a pro-cyclical growth sector that underperforms when capital spending and the economic cycle contract. But water funds can have a much more stable regulatory outlook with strong cash flow and cash conversion. That's pretty much because for say water supply or say maybe water supply management, the capex is likely to be lower than say clean energy. So and then water is an essential utility, so cash flow generation and cash conversion may be better than say clean energy sector. Impact investing. Invest with the intention of producing positive, measurable social and environmental impacts without sacrificing financial returns. But then, even so, for impact investing, social objectives are prioritized over returns. It pretty much means that social objectives are prioritized, but then we still want positive returns. And it is So impact investing is still not the same as say charity. We still want positive returns, but then we put more focus on the social environmental impact. And the investment strategies often align themselves to some of the 17 SDGs of the United Nations. And because social objectives are prioritized over returns, so it's vital to build and review reporting frameworks. Therefore, that pretty much means that the kind of more conventional reporting framework focusing on returns or maybe comparison benchmark may not be totally appropriate. And impact investing can be challenging for certain asset classes like equities, as investments cannot be easily identified to be directly related to SDGs. But we need to analyze equity issues, source of revenue and services, regions, sectors, benefits made to the SDGs, and exposure, if any, to sustainable forms of agriculture and aquaculture. Okay, near the end of this chapter, describe approaches to managing passive ESG portfolios. Passive investment differentiates itself from actively managed strategies by the nature of its low cost and the simplicity of a determined rule-based approach. Exclusion-oriented responsible investment approaches were early adopters of passive investing. But then, with problems of ESG data, such as lack of X-ray, comparability, and regional breadth, and the voluntary nature of ESG disclosures, mean that the methodology behind passive ESG strategy is highly individualistic and interpretive, with different providers based on different selection methodologies. So it is kind of quite different from passive investment in the more conventional sense. Say in the conventional sense for passive investment, it pretty much means that you're tracking index. So say there may be different portfolio managers tracking the same index, and the outcome will be quite similar. But then for passive investment, if you track different if you track the same ESG index, the way that the index is constructed with a lot of subjective judgments. So unlike say for index, there are a lot of mechanical rules in index composition. So even if you do a kind of passive ESG investment, because of the way the ESG benchmark is built, then there will still be a lot of sort of subjectivity compared with the rules that are being used in constructing a normal say equity benchmark. And indices that are ESG consistent may well exclude or minimize exposure in sectors like tobacco and fossil fuels, which tend to be more mature and face less pressure to reinvest cash flows in the growth-related programs. Such exclusions will naturally tilt portfolios to a more cyclical and growth-oriented profile. Exclusions will also limit the scope of diversification. Maybe I can give an example. In certain Asian countries, there are so-called Sharia funds. Sharia funds are those funds that comply with Islamic principles. So in this one, they'll exclude the so-called sin sectors like tobacco, and also they'll exclude the finance companies because in Islam, receipt of interest is prohibited. So in these Sharia funds, the main instead considered will be very likely the IT stocks, and then they tend to be a lot more volatile and cyclical compared to say a conventional index with say more stable companies like say banks, but then banks cannot be included in Sharia funds. And finally, a passive strategy limits the ability to engage with portfolio companies unless coordinated by an established stewardship team. Because, well, for a passive strategy, you actually may make a fund, a ESG index, and then, well, unless, well, you actually try to engage directly with every constituent company of the ESG index. So thanks for watching.